Did you know that the financial habits many people rely on are putting them at risk? You see, the average person faces some alarming statistics that reveal just how vulnerable we are when it comes to money. However, most people overlook one surprising detail, which might be the key to avoiding financial disaster. So, curious about what it could be? Well, let's get started. Many people turn to debt consolidation to simplify payments and reduce interest rates, only to find themselves deeper in debt afterwards. Despite its appeal, consolidation loans often have higher interest rates than expected, especially if your credit score could be stronger. One of the most significant drawbacks lies in the upfront costs. Securing a consolidation loan usually involves fees like organization, balance transfer, closing costs, and annual fees. These charges can quickly erode any savings you hope to gain, making debt consolidation less effective than anticipated. It's essential to thoroughly understand these costs before committing to a loan. Another pitfall is the risk of securing a loan with a higher interest rate than your existing debts. If your credit score needs to improve, you might end up with a rate that costs you more in the long run, even if your monthly payments are lower. Moreover, debt consolidation often stretches out the repayment period, meaning you could be in debt for longer. While this might reduce your monthly payments, it could also lead to more interest paid over the life of the loan. There is also the danger of increased spending. After paying off credit cards with a consolidation loan, some may feel a false sense of financial freedom, which can lead to accumulating even more debt. The cycle will likely continue unless the financial habits that lead to the original debt are addressed. Therefore, it's crucial to adapt better financial practices and budget wisely. Debt consolidation might simplify payments, but without tackling the underlying issues, it could lead to more financial trouble. The range of medical expenses is broad, covering everything from hospital bills and doctor visits to prescriptions and necessary medical equipment. Insurance only sometimes provides complete protection. Many face high deductibles, co-payments, and other out-of-pocket expenses that add up quickly. For instance, a report by the Kaiser Family Foundation highlighted that the average annual premium for employer-sponsored health insurance surpassed $23,968 for a family coverage in 2023. Despite having insurance, many struggle to afford the care they need, creating a vicious cycle of debt and financial strain. Medical debt carries severe consequences for financial health. Many people delay care due to costs, worsening their conditions and leading to even more expensive treatments later. This delay not only harms their physical health, but also deepens their financial woes, as untreated issues often escalate into more serious and costly conditions. Medical debt is a significant contributor to bankruptcy in the US, with studies showing that nearly 2/3 of those with medical debt face it due to unforeseen events or ongoing conditions requiring expensive care. Beyond the financial impact, medical debt also takes a toll on mental health, causing stress, anxiety, and a sense of hopelessness. The stigma around financial difficulties can lead to isolation, making it harder for people to seek help. The cycle of financial instability created by medical expenses is complex and devastating, forcing individuals to make impossible choices, like prioritizing medical bills over basic needs, which only perpetuates the cycle of poverty and deteriorating health. Gig jobs cover a broad spectrum, from ride-sharing and food delivery to freelance writing and graphic design. While the freedom to choose assignments and set hours can be attractive, it also leads to income instability. Unlike traditional jobs, gig work doesn't guarantee a regular paycheck, and many gig workers face fluctuations in their earnings, making it difficult to manage monthly expenses or save for the future. Financial disparities between gig workers and traditional employees are stark. Studies show that gig workers often earn significantly less, about 58% of what full-time employees make, according to the report by Prudential. This income gap is further widened by the lack of employer-sponsored benefits like healthcare, retirement plans, and paid leave, leaving gig workers without a safety net and vulnerable to economic hardships or personal emergencies. The unpredictability of gig work can make it challenging to cover basic living expenses. Many gig workers need help with financial instability, making it difficult to secure loans or mortgages, as lenders typically favor those with steady income streams. This financial volatility can trap gig workers into a cycle of insecurity, limiting their opportunities for upward mobility. The mental and emotional toll of gig work is also significant. The constant pressure to find new gigs and maintain high ratings can lead to anxiety and burnout. The competitive environment often forces gig workers to work longer hours, resulting in an unhealthy work-life balance and increased stress. Over time, the lack of retirement savings options further compound these challenges, leaving many gig workers facing financial difficulties as they age, with inadequate personal savings and a dangerous financial future. Homeownership is often seen as a significant financial achievement and a reliable way to build wealth. However, many prospective and current homeowners need more attention to be involved. While the mortgage payment might seem affordable, the additional expenses, such as maintenance, property taxes, insurance, and utilities, can quickly pile up, creating financial stress if not adequately planned for. A recent study revealed that the average American spends approximately $623,200 over 13.2 years of homeownership, with the most substantial expense being mortgage payments, $270,500, maintenance and renovations, $192,100, and utilities, $54,600. These numbers illustrate the heavy financial burden beyond just making a down payment and covering monthly mortgage bills. There are also unexpected costs, like replacing appliances, repairing the roof, or overhauling an HVAC system, which can also catch homeowners off guard. Experts recommend setting aside 1 to 2% of the home's annual value for maintenance and repairs, which can quickly amount to thousands of dollars annually. Other ongoing costs that vary significantly depending on the home's location are property taxes and homeowners insurance. The average property tax across the country is about 1.1% of the home's assessed value, though it can now be as low as 0.4% in some states and 2.2% in others. Insurance premiums also fluctuate based on the home's value, location, and level of coverage. While these expenses are often bundled into monthly mortgage payments, they can strain a household budget significantly if rates unexpectedly increase. This is where the term house poor comes in. It describes homeowners who spend much of their income on housing costs, leaving little room for other expenses or savings. According to the Urban Institute, nearly 1 in 4 homeowners with a mortgage falls into this category, spending over 30% of their income on housing. Being house poor can lead to financial stress and make savings for emergencies, retirement, or other goals difficult. It can also hinder the ability to afford essential home repairs or upgrades, further straining financial challenges. Retirees today face an increasingly complex financial landscape, especially when withdrawing from retirement savings. A significant issue many encounter is withdrawing funds at unsustainable rates, which can lead to the early depletion of their retirement nest egg. The widely referenced 4% withdrawal rule, often misunderstood or misapplied, contributes to this silent crisis, leaving many retirees financially vulnerable later. The 4% rule, introduced by financial planner William Bengen in the 1990s, suggests that retirees can safely withdraw 4% of their retirement portfolio each year, adjusted for inflation, over a 30-year retirement without running out of money. While this rule provides a helpful guideline, it isn't a one-size-fits-all solution. Many retirees overlook crucial factors like their specific life expectancy, individual spending needs, and varying market conditions, all of which can drastically affect the sustainability of their withdrawal strategy. Unfortunately, statistics show that a significant number of retirees withdraw funds at rates that exceed this guideline. Nearly 30% of retirees draw more than 4% annually, often to maintain their pre-retirement lifestyle or to handle unexpected expenses. This approach, however, significantly increases the risk of exhausting their savings prematurely. The 4% rule is also based on historical market performance, which may not reflect future realities. Fluctuations in the market, inflation, and changes in spending habits can all undermine the effectiveness of a rigid withdrawal strategy, leaving retirees at financial risk. Moreover, many retirees fall into the house poor category, where much of their income is tied up in housing costs, leaving little for essential expenses. As housing costs rise, they may feel pressured to withdraw even more from their retirement account, further endangering their financial security. To avoid the pitfalls of managing withdrawal rates, retirees should adopt a more flexible approach, regularly reviewing their financial situation, adjusting withdrawals based on market performance, and exploring alternative income sources like part-time work or annuities are all strategies that can help maintain financial stability. Working with financial advisors to develop a tailored plan can also be invaluable in ensuring that their withdrawal strategy is sustainable. Well, it's surprising how many high-income individuals struggle with fundamental financial concepts. Research shows that high earners often have less financial literacy than those with lower incomes. This paradox can be linked to a lack of formal financial education and a tendency to rely heavily on financial advisors or tools without fully grasping the basics. The confidence that comes with a high income can also lead to complacency, causing some to neglect proactive learning about personal finance. And well, the consequences of this financial illiteracy can be severe. High earners may make risky or poorly informed decisions without a solid grasp of investment principles. They might heavily invest in high-fee mutual funds or chase trending stocks without considering the long-term impacts. A lack of knowledge about diversification, asset allocation, and market volatility can result in significant financial losses, eroding their security. Moreover, high earners often feel pressured to maintain a lifestyle that reflects their income, leading to excessive spending. This behavior can create a false sense of security, where they believe their high income will always cover their expenses. However, even high earners can only live paycheck to paycheck with proper budgeting and financial planning. The need for more awareness about the importance of savings and investing can further worsen this situation. The broader implications of financial illiteracy among high earners are concerning. Many fail to save adequately for retirement, setting themselves up for precarious financial situations later in life. Studies have shown that financial literacy is closely tied to effective retirement planning. Those with excellent financial knowledge are more likely to contribute to retirement accounts and make informed decisions. Without this knowledge, even high earners may face financial hardship in retirement despite their seemingly ample resources. Wage stagnation is a significant issue that often goes unreported in discussions on economic health and worker well-being. Despite the rising costs of living, many workers have seen their wages remain stagnant, particularly in specific industries. For instance, between 1979 and 2013, the hourly wage of middle-wage workers increased by just 6%, while low-wage workers saw their wages drop by 5%. In stark contrast, high-wage workers enjoyed a substantial 41% increase in their hourly earnings. This widening gap underscores the growing inequity in wage distribution, where the rewards of economic growth have yet to be shared equally. The standard narrative around wage growth often fails to acknowledge that many workers, especially those in service-oriented or low-skilled jobs, have yet to see meaningful pay increases. A large segment of the workforce, including recent college graduates, is grappling with stagnant wages, leading to long-term financial struggles. For example, inflation-adjusted wages for young college graduates have decreased since the late 1990s, showing that even a higher education no longer guarantees financial stability. The situation is made worse by rising inflation, which erodes purchasing power. As essentials like housing, healthcare, and education continue to climb, workers need help to make ends meet. With wages not keeping pace, many are forced to stretch their income further, often resulting in increased debt and financial insecurity. This makes it difficult for individuals to save for retirement, buy a home, or invest in their education, leading to a cycle of living paycheck to paycheck and struggle to plan for the future. So, from this, what steps will you take today to safeguard your financial future? Let us know in the comments below. If you found this video helpful, give it a thumbs up, subscribe, and don't forget to turn on the notification bell for more amazing videos.